So this is the next concept that we are going to discuss is cost analysis. Can anyone say what is cost? The cost is nothing but the expenditure that you are going to spend in your production on your inputs, on all the inputs, whatever the amount that is spent for producing a particular product. So that is nothing but the cost. So here in cost analysis, you are going to identify how these expenditures are going to behave with respect to various production levels. So if you are going to increase the production level, scale is nothing but the level of production. So if this level of production is going to increase, how the costs are going to affect, that we are going to see here. And here not only this how many quantity of output you are producing, so it also depends on the prices of factors of production. Factors of production is nothing but the inputs of production, land, labor, capital, all those things are there, no? So if all those prices increases automatically, that will affect this cost. And size of output, how much quantity of output you are going to produce, and how many operations you are using. That means different processes you are going to using. Number of processes are there, automatically cost will be affected. So all these are going to bring change in the cost analysis. You can say that all these are the factors of cost. That is the scale of operation, prices of factors of production, size of output. And not only size of output, the technology that you are going to use also affects here. So you can show this in a cost function also in some single equation also. You can show that what are the factors of cost that it is going to be affected. So cost analysis definition you can see here. This is mainly used for measuring how the costs are changing with relation to the output. So if outputs are increasing, expenditure increases, no? So how these are related with? So how the different costs are going to affect and how to measure that. So this cost analysis is also called as what? Cost output relationship. Because you are going to measure between this cost and the output, no? So it can be said like a cost output relationship analysis. So here all the economists has considered this cost, how the inputs are increased or decreased. Based on that, cost is going to be depending. So that is what the economist says. So that will be affected here. The inputs will be affecting the cost. If you go on increasing, your expenditure also increases. And your productivity, if you are going to rearrange also, some expenditure you are going to spend. So the rearranging means nothing but some processes, if you find after analysis, if you find one or two processes are unnecessarily included, so if you are going to delete those processes also, you are going to incur some costs, and you are going to rearrange the previous process, no? So it will be done only based on by incurring certain costs. So anyhow, we need to reduce this cost, and we need to increase our production, because it is going to affect the cost of production. If you control the cost, that will control the cost of production. So cost of production is most important here, because this is what it is based on what we are going to fix the price of the product. So in simple words, we can say that it is a cost of production means the total expenditure that you are going to spend on the inputs of production. So what are the various costs that are going to be affected, how they are going to related with how they are going to function, and where to control. We are saying that always the cost of production should be reduced, no? So if you know what are the different costs that you can control, then only you can reduce that particular cost of production. Otherwise, it is not possible. So what are the costs where you can control that you can understand by using this cost concepts. So which will help you to find out the optimum level of production. So this cost output relationship is going to determine that optimum level of production. How to identify that optimum level of production also we will see. So if this relationship will help the manager in not only cost production, you can also predict the profit also. Because if you reduce the cost, at what price you are selling the product, you can identify the difference between the price and the cost is nothing but the profit. No? And if you want to increase the profit without changing the price, you need to concentrate on cost control. So if you cannot control this cost, you cannot increase your profits. And this will help you in fixing the price of the product also. So if you know what is the cost per unit, you will add certain profit to it, and uh, what is the price that you can determine there, that at which the product should be sold. So in all these cases, you can use this cost output relationship. So this can be shown in an function. Wherever you see that cost function, demand function, production function, nothing but these are going to be shown in a mathematical formula. As we have shown production function, no? Production function is equal to f of. F of indicates that it is a mathematical formula, which indicates that it is a cost function. Here in economic terms, we will call it as cost function. So how this cost is going to function, how this is going to be related. So certain determinants are there, no? So as we have seen, the size of the production, etc. So that all those determinants we are going to show in a single equation, that is C is equal to F of S comma O comma P comma T, etc. So what S stands for? C means already you know that cost. This cost may be per unit cost or it may be total cost of production. So if you take a per unit values of size of plant and different determinants, that will give you cost per unit. If you take total expenditure on all these factors, that will give you total cost of production. So S stands for size of plant or scale of production. How big your plant is, or how big this will be, plant will be based on the quantity of production, how large quantity you are producing. So based on that, your size of a plant will be depending. And O stands for output level. Output level means what is the quantity that you are going to produce, whether you are going to produce 10,000 units or 1 lakh units or 2 lakh units. Based on that only cost will be affected here. And prices of inputs, so all the inputs which you are going to use for producing the product, their prices are also going to be included to find out the cost. So if you include all these things, then only it will give you the total cost of that particular quantity of output. And T stands for technology, you know that. So how much technology or what technology and what is the expenditure on the technology, that should be included here. So all these we can say that these are the factors affecting cost. So if you show all these things in a single mathematical equation, C is equal to f of s comma 0 comma p comma t, this is nothing but called as what? Cost function. So cost function may be given in short answer questions. Cost function or production function or demand function. You have to keep in mind that what are the factors that are affecting those particular cost, production or demand. And you are going to give it in an equation to find out the cost function or production function or demand function. And coming to in detail discussing about the cost, what are the different types of cost that you will come across in your producing your product. So that we will see in cost concepts. So these cost concepts can be divided into different types. First, I am going to discuss about the fixed cost, variable costs. I am giving the glance of all the costs, and let us see all these types, and then we will go in detail about each and everything. Semi-variable costs, total costs, average costs, marginal costs, outlay and opportunity costs, incremental costs, direct or traceable costs, traceable or non-traceable, you can call it as, and non-traceable costs, direct costs or indirect costs, accounting and economic costs. So sometimes they may be asking you the differences also, short run and long run costs. So sometimes they may be asking you difference between fixed cost and variable cost, marginal cost and average cost, like that. So you must be able to explain all those things. First, let us discuss about the short run and long run costs, because this is most important to divide the costs. So what are the costs that are going to be included in short run? A short run means this is a short period, no, within 1 year period. So where you cannot increase the physical capacity of the firm, firm or a plant or a production unit. So there certain that capacity will be fixed. So where you cannot increase it immediately. So in such cases, some costs you are going to include here. That is increase of output will be possible only to the extent of the technology that you are going to already you are having. So not more than that. So if you are having a machinery of 1 lakh units of production maximum capacity, so above 1 lakh you cannot produce within this short period. You can reduce, but you cannot increase more than 1 lakh capacity, because the capacity of the physical technology is limiting to that particular extent. So this will be short run cost will be this will be varying when the when the plant and the capital are going to be kept constant. So you can see in the short run two types of costs. One it is fixed cost and the other one it is variable cost. Some costs will be constant. Constant means that are going to be incurred even if the production is there and or not there. Like such example you can take, like rent for a building. You need to pay even if you are in that building, if you utilize that building, or if you are not going to utilize that building, no. So such costs are called as what? Fixed costs. And variable costs are there. So what are they, that we will discuss in detail, but in short only you can see this type of two types of variable costs. One it is fixed cost, and the other one it is variable cost. So fixed cost means this is an short period, no, within 1 year period. You cannot increase more than 1 lakh capacity, because the capacity of the technology that you are going to costs, fixed costs and the variable costs. So when you are going to find out the total cost of production, that can be obtained by adding both these fixed costs and the variable costs. So in short run, this is how the cost will be. And when variable costs are not going to be incurred, in such case, total cost will be equal to fixed cost, because variable costs are zero, no? So even production is there or not, you need to incur. And coming to the long run, you can long run means long period, no? More than 5 years period. So there you can vary, even output you can bring change, even technology you can bring change. So there everything can be, everything means here every input can be changed. There is no limit that you cannot change, because you are having plenty of time to bring change. So automatically here in this long run, you cannot find fixed costs. All the costs will be varying. Even fixed costs will also vary, because the rent will not be same. So that may vary, no? In long run. In long run, for this for 1 year period, it may be fixed, but after 1 year, it will be changing. So they will increase, no? The owners may be increasing the rent, so which we can say that it is varying. So this will help you how to take the investment decisions. So where to invest, which projects you have to accept, or which technology you have to bring into the bring into your organization. So for that, this long run cost will be helping you. So in long run, we are going to see only variable costs. So TC, total cost, is equal to variable cost, because fixed cost also changes, no? They will be converted into variable cost. So there you cannot see the fixed cost in long run. So TC is equal to variable cost in long run. Okay, so these are the short run costs and long run costs. So coming to the fixed costs, what are the fixed costs in detail? Let us see. So fixed cost means I already gave you one example. No, these are going to be available only in short run, and they are same, no change in the cost. So that is the reason which are called as what, fixed cost. Example also I gave you, no, interest, even salaries you can take, permanent worker salaries also you can include in this fixed cost. Because even if production is there or not, you need to pay the salaries to those persons who are permanently appointed. So if they are temporary, that comes under the variable cost, because if whenever you produce only, you will be using such people, no? You need not pay, because they are not permanent in the company. So these fixed costs are utilized here to find out the cost of product also. And you can include this in profit and loss account. While discussing profit and loss account, I will explain you about this. So what are that comes under the fixed cost is rent. Even lease, for lease, if you are going to take, you need to pay rent, no? That you are going to include. Your salaries related with the permanent employees only. And if any insurance is there, that amount you need to pay. And property taxes are there, means that also you include in fixed cost. And any interest means this will be paid on your capital that was borrowed. Monthly you need to pay. You are going to continuously pay. that comes under this. And even depreciation also you are going to include in this fixed cost. So depreciation you need to pay on machinery which is going to be purchased, no? So that not paying. You are going to calculate on machinery because due to usage of that machinery, some value will be reduced, which is treated as what? Depreciation. So that reduction of value is called as what? Depreciation. So that is included in this fixed cost. So all these are the examples of the fixed costs. What happened to this? And this can be fixed cost can be drawn in a graph also, how they are flowing. So another example is given here. If you are going to live in any rented place, rented house, there whatever the rent that you have agreed to pay, so that comes under this fixed cost. And this is going to be changing after 1 year period or after a fixed lease period. Only this rent will be changing. So then it is included in the variable cost till the period of agreement that the rent is not going to be changed. That comes under the fixed cost. And also you can take this another example also you can take to say this fixed cost, property tax. So property tax also you need to pay monthly some amount, no? So that is included in this fixed cost. So you can show this in a curve. How this is shown in a curve means you are going to take x-axis and y-axis, and on x-axis you have to show the output, and the cost should be shown on the y-axis. Always we are showing the output on the quantity on x-axis. You might have observing, right? Even demand means demand of we are showing on x-axis. Supply means supply on x-axis. That is related with the output. Whatever the output is there, that we are showing in x-axis. Only the y-axis we are changing. And the fixed cost curve will be flowing like this, parallel to x-axis, from left to right in a straight line parallel to x-axis, because there is no change in the, even whatever the output, even you are going to produce 10,000 units, 1 lakh units during that period, or 2 lakhs or 10 lakhs also, the cost that rent you are going to pay will be same, right? So for that reason this will be, even production is increasing, go on increasing to what extent? Unlimited extent during the short period. The fixed cost will be same. So this is how you are going to show the fixed cost. And coming to the next cost, that is variable cost. So variable cost means the name itself is indicating you. Variable means varying, changing. So this will be changing continuously, depending on your output and depending on your inputs that you are going to use. Example, you can take raw materials. So when you are going to incur the raw material cost, when there is output. If there is no production, you're not going to use the raw materials. There is no need of variable cost there. If you are going to increase the sales, you will increase the output. If output is increasing, variable cost also increases. Okay. For example, here it is given a bakery. A bakery example is given. The cost of flour. Flour is nothing but the raw material. So floor expenditure is included is here as an variable cost. So whatever may be the product, the raw material that you are going to use there, it is included as an variable cost. So your sales commission, labor cost, direct labor means here temporary or sometimes some employees will be related with only the production. If production is there, those workers will be paid. Otherwise, they are not paid. So all those are called as direct labor. So whatever the salary that you are going to pay to them, that is included in variable costs. The cost of raw materials and anything, any tools, etc., that you are going to use. Even for machinery, you will be using certain oils, no? Oils also included in variable costs for running the machinery. So all those are called as what? Variable costs. So how to show this variable cost curve? You can let us. Some more examples I gave here, like laundry. So there will be proportionate change in the variable cost and the volume of output. If output is going to increase, variable cost increases. If output reduces, variable cost decreases. So they are positively related. Volume of output and the variable cost. Again, this can be calculated by using this formula. Variable cost is equal to output into variable cost per unit. Per unit value, if you know that, you are going to multiply with the output that you have produced. That will give you total variable cost. So this can be shown by drawing a graph, x-axis, y-axis, and on x-axis you are going to show the production or output. Y-axis you show the cost, total cost, variable cost, and this will be flowing from horizon. See, you can see here, it is flowing, it is touching the horizon. Why it is touching the horizon means if the output is 0, variable cost is also 0. So that is the reason this will touch this horizon. No output, no variable cost. So output, if it is increasing on the x-axis, so variable cost also increases. So that is the reason this is flowing from left to right upwards. So this is called as variable cost curve. So this is how you can draw the variable cost curve. If the output is gone reducing from x towards horizon, variable cost also decreases from right to left. If output increases from horizon to x, towards x, variable cost also increases from horizon to towards upwards. This is flowing from left to right upwards. Variable cost is flowing from left to right upwards. Can you say what are the differences between this fixed cost and the variable cost? There is a difference in meaning itself. Fixed cost means those costs which are remaining constant for a particular period, time period, irrespective of output. Even whatever the output you are going to produce, so it won't matter. That will be constant, that's all. Even 0 output is there, you need to incur. Even 1 lakh, same amount you are going to incur, or even 10 lakhs of output you are producing, you need to incur the same amount. So fixed, that's all. They won't change along with the output. Variable cost means these will be directly proportional to the volume, that is output, level of output. If output is 0, variable cost is 0. If output increases to 10,000, it will also increase. If it is increased to 1 lakh, it will some more increases. So these both are directly related or positively related. The meaning itself, there is difference. And even they're incurred when these are existing, fixed cost and variable cost. In that also, this is there is difference. If output is 0, fixed costs are incurred. And if the variable cost will be incurred only when output increases, and it will decrease when output decreases. So this is the difference between the fixed cost and the variable cost. So first line indicates the fixed cost and the second line indicates the variable cost. So fixed costs are also known as, you can call them as overheads, or you can call it as period costs or supplementary costs. So these are the other names of fixed costs. And variable costs are also called as referred costs or prime costs or direct costs, you can call them, because they are directly related with the output. No? So direct costs also you can call them. So and what is the nature of fixed costs? So they are fixed costs are related with the time period. So if in a particular period, these fixed costs will be constant. After that period, these will be changing, but in short period, this will be fixed. Whereas variable costs, these are not related with the time period. They are related with only the output. Examples of fixed costs I gave you, depreciation, interest paid on capital, rent, salary, property, taxes, insurance premiums. All these are fixed during a particular period. And coming to the variable cost examples, commission on sales, credit card fees, wages of part-time staff, all this comes under the examples of variable costs. Second line indicates examples of variable costs. First line indicates fixed cost examples. Okay, so these are the differences you may expect in short answer question. What are the differences between the fixed cost and the variable costs? And next comes semi-variable cost. In between, semi-variable means half part will be fixed and half part will be variable cost, varying. So, semi-fixed, or you can call it a semi-variable, because some part is fixed and some part is variable. Both the fixed and variable cost will be there in this. Both elements will be existing. So we can say that even output is there or not, some costs are needed to be increased, and after that it will be changing. For example, you can take this your telephone bill. How you need to pay some amount that you need to pay even if you utilize or not. Fixed amount you need to pay. like now you are having SIM cards, no? So to get the incoming and outgoing, minimum at least 50 rupees you have to pay, which is called as fixed cost. And it will be varying with the usage. If you use more, you need to more after that limit of 50 rupees. Even data cards also. More data if you use, you need to pay more data, more amount. So that means half part is fixed and half part it is varying due to your usage. How much you are using more than that limit, you can use it, but you have to pay more. So how this curve will be flowing? Any other example you want to give for semi-variable cost? So same output on x-axis and cost you are going to show. So this is how the variable cost will be varying. Some part it will be constant and some part it will be varying. Okay, so it is increasing. So which we can say that it is semi-variable cost. It is looking like an ladder, no? So like that, semi-variable cost will be. To some extent, it will be fixed. Fixed means parallel to x-axis, and it is varying, increasing. Here it is a straight line. It is given, but some slant like you can give here. Slant. As variable cost is flowing, no? Like that you give some slant here. And next comes total cost. So total cost also you can divide them into short run cost and short run total cost and long run total cost. While discussing about the short run and the long run, no, we have said total cost is equal to fixed variable cost plus fixed cost plus variable cost. So you are going to calculate in short run, TC is equal to fixed cost plus variable cost. If variable cost is equal to 0, then total cost will be equal to fixed cost. When you come to the long run, total cost will be equal to variable cost, and there won't be any fixed cost in that during that long run period, because fixed costs are also going to be varying, which will be included in the variable cost. You won't find fixed costs in long run. How these curves are going to flow? Let us see. With this, I will end here. On x-axis output, y-axis cost. So this is called as variable cost, which is flowing from origin is variable cost. And the fixed cost will be flowing from some limit above the origin. So whatever that may be, that will be fixed throughout the output. And variable cost curve, total cost curve will be flowing from this point where the fixed cost curve is flowing. So you must be very careful to remember this. So total cost curve will flow from the fixed cost point. So if it flows from variable cost point, that becomes the long run total cost. Okay, so in short run, you are having coming across fixed cost and variable cost, no? So this is how it will be. Total cost curve will be parallel to variable cost curve. See, same like variable cost, total cost is increasing, but the thing it is started from fixed cost. This point, not from the origin. So this is how the total cost curve will be in short run. In long run, I will show this and I will end here. So both are same, no? So production this where total variable cost and the total variable cost and the total cost will be same. There won't be any fixed cost. So both will be flowing from the or essentially here. So TC is equal to VC. Okay. So this is what it is happening in the long run. So all these are the important topics that you have to. One is related with the other. So all these are in sequential order. So after total cost, we will go for the average and marginal cost that we will see in the next class. I am stopping here. Any doubts in understanding these concepts? Any of you?